Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner, practitioner, and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. As of release, it is just after Memorial Day weekend. Hopefully you had a wonderful weekend with friends and family. And in today's episode, I'm going to talk about how to decide. I'm going to continue that investment theme. I'm going to talk about how to decide the right mix of stocks in real estate and bonds you should have in your portfolio, which is just your combined mix of all of your investments going towards one goal. In 2 episodes ago, I talked about investing basics. And that was episode 58, or you can go to optometrywealth.com/58, and I'll throw a link to that in the show notes. And I talked about what are stocks and bonds and real estate investment trusts, and what are the roles that they play in your investments, in your portfolio, your mix of investments. We talked about how stocks provide the growth of your investments over time, and bonds provide stability. Depending on the type of bonds you own, I'm assuming relatively shorter term, higher grade, investment grade bonds. In my mind, the role for bonds is to provide stability. And we talked about mutual funds and ETFs, which are my preferred method of investing, rather than trying to select individual securities, individual investments, individual companies, individual bonds. And we talked about the relationship, the trade-offs between risk and reward in these investments. And of course, when investing, you should look at the whole mix of investments as one portfolio going towards one goal, not just the individual fund, not just the individual stocks. Look at every account, whether it's your 401k, your IRA, your taxable investment account. Look at every account that's going towards one particular goal and all the investments inside of it as one portfolio, one mix together. How do they all fit together as a whole? How does the portfolio as a whole behave rather than each individual piece? And what does adding new investments into that mix due to that mix as a whole? So looking at that, how do you decide then how much of your investments should be in equity type investments, which are those stocks and some real estate as well, versus the bond type investments in your investment mix? What percentage of your investments should be in each different category? How much should you have in those growth drivers versus the stability? How much should you be leaning on the gas pedal versus the brake? And that's exactly what I'm going to dive into today. I'm going to talk about the different factors that you should be keeping in mind when you decide how much of your investments should be in stock type investments versus the more stable, typically stable, generally stable bond type investments, at least related to stocks. And I'll talk about the different factors that factor into that and how that changes over your lifetime, over your career. And ultimately, when you're making this decision, you're thinking about the trade-off between risk and reward. Ultimately, you're trying to find the right balance between the different risks you're willing to take and the reward or the return that you're expecting for taking on those risks. All investing involves risk and uncertainty. Even the risk-free investment, the shortest term government debt, it involves some level of risk. There's things you can calculate to happen with a reasonable probability, and there's things that you can't really possibly predict. You can't realistically put a probability, a percentage on it. And risk is generally, the way I look at risk is it's sort of like energy. Like if you think back to the laws of thermodynamics, risk can't be removed altogether. It can't be destroyed. It can only be shifted around. It can be transferred or hedged against. It can be transformed. You can shift it around from one risk to another. You can lower one and increase another. but you can't remove risk altogether. It's always going to be present in your life in some way. An example of that is holding cash. Like you can just literally hold cash your entire career and never invest any of it. Well, what's happening there? Well, you are lowering one risk, the risk that your cash will decline in value. Obviously, if you have $1 in the bank, it's going to remain $1. It's never going to change. So you've lowered the risk that your cash will decline in value or fluctuate, right? There's no volatility in the cash sitting in your bank account. So you've lowered one risk and you probably feel maybe more comfortable in the short term. But what's likely to happen? Well, inflation is going to destroy the purchasing power of that cash. So although the value won't fluctuate, you're not going to be able to buy as much with the same amount of dollars as you did in the past. And you're very likely not able to save enough to build enough wealth, to build enough dollars to become financially independent. You're very likely to burn through that cash throughout your retirement before the end of your life. So what have you really done? You've lowered one risk, that the risk of volatility or your dollars decreasing in value, and you've dramatically increased another risk down the road, which is inflation eating away much of the value of your wealth and you running out of money in retirement. So you've shifted it from one to another, from current comfort, you've added current comfort, but you've increased future discomfort. So risk essentially can take on different forms, but you can't get rid of it altogether. So the key really is deciding which risks you're able and willing to take on versus the expected reward that you're going to receive, or at least expect to receive to take those risks on. And there are many risks. There are investing specific risks. There's the risk of losing money altogether in an investment. Although by diversifying, by owning not just one company, the stock of one company, but the stocks of many companies in one industry, but not just one industry, by owning several or all industries, and not just the US, but owning stocks all over the globe. By diversifying, you're basically able to diversify away the risk of losing your money altogether in one business, right? The fortunes, the fate of one company does not necessarily impact your overall wealth as much when you own 12,000 companies. So diversification is really able to help you diversify that particular risk of losing that money altogether based on the fate of one particular business. And you can solve that by broad diversification. There's the risk of overall volatility or the fluctuations in the prices of your different investments, and the risk of declines, which do happen. There's economic risks and geopolitical risks specific to each country or geographical region. And so you start to tackle and manage those risks by being invested in different asset classes like stocks and real estate and bonds. You can be diversified in different countries and sources of income for businesses, or even factors or characteristics of investments that academic research would show are robust and provide a way to diversify different sources of risk and add potential sources of additional return. Things like value or smaller companies or profitability. Those are certain characteristics that at least quite a bit of academic research would show that tilting towards those factors or factors like those, meaning owning more of the investments with factors with characteristics like that than the overall market would have, adds more risk to the portfolio, but has shown to compensate you for that risk historically with higher expected returns. So you can even add to your portfolio or tilt in your portfolio towards certain characteristics. So there's a lot of ways to sort of tackle and spread out and diversify the risks based on how you are allocating or choosing to invest your dollars. And there's a lot of different other type of risks, especially when you're thinking about retirement planning. There's the risk of inflation on your spending ability. There's the risk of additional healthcare expenses or There's a risk of additional healthcare expenses. There's also what we call sequence of return risk, which means that you really don't know the timing of returns. You might get a really bad batch of poor performance right as you're about to retire and start withdrawing from those funds. So there's a lot of different risks that can come up in your life financially that aren't just volatility. When most people think of investing and risk, almost everyone thinks about the fluctuation of prices. But that's not the only risk you should be thinking about, and maybe not, depending on where you're at in your career, maybe not even the primary form of risk you should be thinking about at all. So now that I've gone through that spiel about risk and the different risks that we face and think about when we invest and build wealth and make financial decisions, let's dive into the main question. How do you know how much of the main asset classes that you should hold? What percentage of your investment should be in stocks versus bonds? There's three things you want to think about when making this decision. Your ability, your willingness, and your need to take on investment risk. So let's dive in. Your ability to take risk. Do you have the financial ability or capacity, risk capacity, to take on investment risk, and how much? Your ability to take on risk, your capacity depends on a few things. There's your time horizon. This might be one of the most important things that you need to keep in mind when figuring out how to invest your money is what is your time horizon? How long do you have before you need those funds? What is your investment goal? Is it for a house down payment a year from now? Is it for long-term financial independence, for long-term retirement? What is that time horizon? How many years do you have until you get to that point where you're going to need to use and spend those dollars? In general, I really like to think of separating out your dollars in terms of buckets of time, right? There's the shortest term bucket, which is money you might use tomorrow or within the next year. Your emergency fund or opportunity fund is essentially a part of this shortest term bucket. There's like your midterm bucket, which is dollars that you might use over the next 5 to 8 years, or to where you don't really have a specific goal in mind, but you want it to be available just in case an opportunity comes up over the next several years. A lot of times for practice owners, like that's sort of a taxable brokerage account you might use for commercial real estate purchase or for an investment in the practice or just to have for liquidity. So that midterm bucket. And then there's that long-term bucket, which is really anything that's 10 years and beyond. That's your long-term financial independence. That's college expenses for kids over the next 10 to 18 years. So think of your dollars in terms of buckets of time. And this will help you determine not only how to invest those dollars, what to do with them, but also which accounts you should be using. You don't want to put short or midterm dollars in a retirement account that you can't get access to without restrictions or penalty. So it's going to help you with both of those things. And why is this important? Why is your time horizon important? Well, we can look back historically and we can see how these different types of investments have behaved historically. For example, let's look at the U.S. stock market, right? Looking at the Russell 3000, and we can go back from 1979 through the end of 2022. When we look at the behavior of U.S. stocks, and when we look at really short-term periods of time, there's quite a bit of uncertainty about how returns are going to unfold month to month, year to year. When we look at 1 month periods, 65% of the time returns were positive over this time horizon, over this time frame. For 1 year periods, 80%-ish were positive. So even though the majority of the time we saw positive returns, there's still quite a bit of variation in this short term. And then we look at the range of outcomes, right? For 1 month periods, the range of outcomes for U.S. stocks for 1 month periods, where the very best was about 13%, the very worst was 22%. That's quite a bit of that's quite a wide range of outcomes for 1 month periods. For 1 year, the range of outcomes was, well, the best 1 year period was 62%. The worst 1 year period was 43%. And that's the worst 12-month period and the best 12-month period. So within short-term amounts of time, there's quite a bit of uncertainty about whether stocks are going to be positive or negative and how wide it's going to be negative or how wide it's going to be positive. So with short-term dollars, you really don't want to invest too heavily in the US stock market or the global stock market because of that uncertainty. If you're going to need those funds in a year from now, you probably don't want to take on that amount of uncertainty. However, when you start to look at longer time horizons, for example, 5 years, 10 years, 20 years, 30 years, the probabilities change. So when we look at rolling 5-year periods ending within this time frame, 90% of those 5-year periods were positive, 10% were negative, and the range of outcomes shrinks a little bit more. So the best 5-year period was 26.9%. The worst was negative 6.4%. Quite a bit more narrow than we saw with 1-year periods. What about 10-year periods? 10-year periods, 94% of them were positive, 6% negative, and the range of outcomes shrunk even more. So the very best was 19.6%, and the very worst was a 10-year period of negative 2.7%. And then 20 and 30 years, there's actually never been, historically anyways, within this time period, a negative performing 20-year or 30-year period. And I think that's also the case with 15-year periods. And when you look at 20-year periods, the range of outcomes actually became positive. The best 20-year period was 13%. The worst 20-year period was about 4.9%. So what does that tell us? Well, short-term periods of time, there's still quite a bit of uncertainty about how returns are going to unfold and really a pretty wide range of outcomes to expect. However, when your time horizon expands over 10 years, 20 years, 30 years, well, returns actually start to get more reliably positive. There's a much higher, much more consistent probability that you're going to see positive returns over that period of time than you're going to see negative, and the range of outcomes shrinks quite a bit with the negative worst period actually getting more and more closer and closer to becoming positive. So if you have a long time horizon, you can rely more and more on the probability of that positive returns, and you have a much narrower range of outcomes when looking at historical data. With a short time horizon, you have quite a bit of uncertainty there. But when we look at bonds, for example, an index of U.S. government bonds within 1 to 5 year maturities, right? So pretty shorter term U.S. government bonds. Within this same time period, the results are actually much different. When we look at 1 month periods, there's still a little bit of uncertainty. So 70% of those 1 month periods were positive, 28% negative. But the range of outcomes is much, much narrower. The very best 1 month period was 2.9%. The very worst was only negative 1.96%, right? So much, much narrower range of outcomes. 1 year periods, 91% of them are positive, 9% negative. When you go 5 years and beyond, 100% of those periods were positive, 0% negative. And so with bonds, the stable portion of your investments, obviously depending on the type of bonds you own, there's much less uncertainty even in the short term. You can rely on the stability much more. Obviously, over the last year or so, that was questioned, right? We saw quite a rough time for both stocks and a historically rough time for bonds, but for longer time horizons, that's sort of the expectation that we see. Now, I do have to add here, right? The past performance is not guaranteed to happen in the future. Huge disclaimer there. There's always uncertainty with investing. That's a part of investing, regardless of what you're investing in. However, the past is helpful for building expectations about what could happen in the future, building a range of outcomes for yourself. So when we look at the past, we see that your time horizon can matter quite a bit with what you can expect in terms of positive or negative returns and the range of outcomes to expect. It also matters when you think about different big declines in these investments. Obviously, we just talked about the worst 12-month period, since 1979. Something I always turn to as well when looking at the past is the way that bear markets unfolded. So really big declines, more than 20%. There have been several since at least World War II. And Ben Carlson, in an excellent post that I will post a link to in the show notes, he had gathered some information looking at every bear market since World War II. All right, and this was through mid-2022. And he looked at every bear market since World War II, and he looked at what was the percentage decline from top to bottom, and what was the average amount of months from top to bottom, and how many months on average did it take to go from the top to break even again, right? So it sort of gives us an expectations to figure out, what should we expect in terms of how long bear markets should last. So it can vary a lot, but on average, it takes about a year to go from top to bottom, and then about 2 years in total to go from top to the break even. So what does that tell us? Well, you have to have a long enough time horizon to not only get from top to bottom to experience that decline, but to get through it to the break even and then beyond, to experience the returns on the other side of that. You don't want to have to sell and spend those dollars right in the middle of these downturns, right in the middle of these bear markets. So do you have a long enough time horizon to do that? And there is quite a bit of research showing that on average, there's pretty substantial returns on the other side of these really huge declines. And do you have a long enough time horizon to take advantage of that, right? To not only experience the risk, but to take advantage of that return on the other side. And so a longer time horizon means you have the ability to wait out these declines, remain invested, and actually purchase some of these shares, some of these investments at discounted prices, ultimately benefiting your longer term returns. As a long-term investor, you have an advantage in that as these prices decline, you can continue to invest, to continue to buy all of these shares at now discounted prices. It also means that you have a higher amount of earning potential. The fancy term for that is human capital. You have a higher amount of human capital, a higher amount of earning potential that's an asset that doesn't really show up on your balance sheet, but is probably your biggest, most stable theoretical asset that you have in your life. And that goes down as you get closer and closer to retirement. But the longer your time horizon, typically speaking, the longer or the higher amount of earning potential, earning opportunities that you have based on your skills and as an optometrist. So, and for dollars that you're investing for long-term financial independence, for retirement planning, think carefully about your time horizon. You're likely going to be planning for financial independence somewhere around 50 to 65, somewhere in that range, right? Somewhere at that point in your life. But even when you get to that point, right, that might be 10, 20, 30 years away. But even when you get to that point, you're not going to sell all of your investments and carry it out as cash. And the reality is you're going to sell portions of your investments to create cash to fund your lifestyle. And the remaining, probably the majority of your investments will continue to be invested for the next 10 years and the next 10 years and the next 10 years. So for much of your investments, your time horizon is really over the rest of your life, over the next, 10, 20, 30, 40, 50 decades or 50 years of your life. That's how long of a time horizon you have. So you have to keep that in mind as you're thinking about, retirement isn't the end goal. That's not the end of the game. That's sort of halftime. You still have to generate enough return. You've got to generate enough return on your capital, return on your investments to generate an income for the next several decades of your life. So that's time horizon. I clearly spent a lot of time on that because it is a really important factor you need to keep in mind when deciding how to invest your dollars. And it also helps you put into perspective what declines mean, because if you are nowhere near selling your investments, nowhere near really needing your investments, and it's really for yourself 30 years from now, short-term declines in these investments don't really affect you financially. I mean, they do affect your net worth, right? Your net worth has declined, your balance sheet's impacted, but it doesn't really impact your ability to live day to day. Doesn't impact your spending, doesn't impact your day-to-day lifestyle. So keep that in mind. It's helpful. Your time horizon is really helpful to helping you put these short-term fluctuations, short-term declines in these investments into perspective. Okay, so that's time horizon. Another factor to figure out if you have the ability or capacity to take investment risk is, there's stability of your income and your need for liquidity. And stability of income, it's, for an optometrist, your income potential and your ability to get another opportunity as an optometrist is pretty stable. Optometry as a profession, I think, is relatively stable. So not a whole lot for you to be concerned about there. Even getting older into your life throughout retirement, there's stability of pension or stability of income in terms of, do you have other stable sources of income like Social Security, or does a spouse have pension income? Or if you work for something like a Kaiser or a larger employer like that, you may have a pension benefit too. That's something to take in consideration. Your need for liquidity. Do you have a need to access these investments, to access the wealth that you've built over the near term, like we talked about, buckets of time? This is a call to build up the proper amount of liquidity in your life, whether it's the emergency fund, whether it's planning for upcoming purchases like a house purchase, or a practice ownership really has a pretty high need for liquidity. Even if you're able to get 100% financing for a cold start or for a practice purchase, you're still going to want to have liquidity, even if it's just to prepare for that underwriting. But also, just as a business owner, you want to prioritize liquidity in your life. And so definitely build up liquidity. This is both cash savings, and for me, I think that taxable investment account can act as a part of that liquidity as well, especially if you're a practice owner. I think that's a really important tool for you. But also, one more thing to think about is do you have other options if things don't go as planned? Do you have flexibility to get other work, to access other sources of income? Just what type of flexibility and optionality do you have if returns for your investments don't go as planned? So that's your ability, your actual financial ability to take risk. The next category of things to think about is your willingness or your tolerance to take risks. Do you have the mental fortitude to handle substantial declines in the prices of your investments, or not even substantial declines, to handle even very little volatility or variability in the prices? And can you stick with your investment approach long term? Where is that threshold to where it goes too much for you? This is really important because ultimately the best investment approach for you is the one you can stick with. We can look at all of the data in the world, all the educational world around how markets work. We can take a look at all of the fancy charts and graphs and spreadsheets, and you can feel really confident. But if it comes down to it, and there's a time where things are not very fun, there's a bear market, there's a market decline, all of that's for naught if you end up panicking and selling out, because people are emotional. We have emotions, we feel things, we feel stress and pressure as our investments, our wealth is fluctuating up and down, mostly down more than up. So this is important. Can you stick with your investment approach? Do you have that mental capacity, that ability to stick with it? But don't lean on this only, right? Don't only lean on your tolerance, your risk tolerance or willingness, because your risk tolerance changes, in my opinion, depending on the environment. People tend to say they have higher risk tolerance when things are going well, when markets are showing positive returns. Then your risk tolerance, as a general rule, tends to go down when things are not going as well. People in general, right? This is not everybody. Everybody handles these things differently. Everybody processes these things differently. But in general, people feel a whole lot less sure about their investments when there's a pretty big decline, or when the economy is going through a scary time, or when there's just a whole lot of fear and uncertainty in the air, whether it's war, whether it's COVID was a big part of that as well, because we had almost all of it all at once in one year. So people tend to feel a whole lot less sure about their investments as uncertainty increases. And another thing is that you really don't know what your risk tolerance really is unless you've gone through these things. I mean, for many of you, COVID may have been that first experience. And even when you go through it early in your career, you don't really have a whole lot of dollars at stake, so you don't feel it as much. So your risk tolerance will change depending on what's going on around you. It will change as you progress throughout your career and you get closer and closer to needing to use these investments. So after getting an understanding of how investment markets work, how these different assets work and have behaved historically, after setting appropriate expectations for how these investments may behave together as a portfolio, as a mix, relative to your time horizon, relative to your ability to handle the risk financially, then decide where that threshold is for you. And set a plan for what you will do. It may be rebalancing, but even if you're in retirement, thinking about where you're going to withdraw certain funds from, set a plan for what you're going to do with your investments when declines happen. Set that plan before those times happen, when things are good and you're thinking soberly, and then try to automate that plan as much as possible. It's a system now. It's out of your emotional thinking. There's no decisions that need to be made at that point. Create a system as much as you can. But your willingness or risk tolerance does matter. It does definitely impact. You shouldn't rely on it entirely, but it should impact or educate the mix that you choose between stock type investments versus bonds. And then lastly, your need to take on risk. What amount of or what range of returns do you actually need to hit your long-term investment goals or financial independence or retirement goals? What do your investments actually need to generate to make it all work? So for example, if you need to take more risk in order to hit let's say you have a goal for early financial independence. And let's say you need to take on a more investment risk. You need to be more heavily tilted towards stocks, maybe even more tilted towards things like value in small companies and profitability, those factors. If you need to take on a certain amount of investment risk in order to generate a potential future return, but you are unwilling to, or maybe you are unable to financially, then what do you need to adjust instead? What are the other levers that you need to pull? What are the trade-offs that you're willing to accept? There's typically, especially when retirement planning, there's typically only a few levers you can pull, but there are other levers. Think about whether you can increase the amount you can save in light of the lower expected returns by not investing as aggressively, or lowering your expenses, lowering your expected lifestyle, downsizing, which will lower the withdrawals or the reliance on your accounts down the road. Delaying retirement. You have a somewhat of control over the timing of when you stop working, or maybe going down to part-time instead of full-time. But just think about what are the trade-offs if you're not willing or able to take on that investment risk over the long term. What are the trade-offs that you're willing to make? Also, something that comes into play is when you start to consider, exotic or alternative investments. Things like limited partnerships or real estates or syndicates, or things like Bitcoin or cryptocurrencies, things that are sort of alternative investments that carry a much different risk and return profile than these broad public markets. This is something that comes into play. These trade-offs are something that comes into play as well, because you really need to think about what risks these investments carry. And for these, especially for these non-publicly traded, non-liquid investments, they'll tout their lower risk profile than publicly traded stocks or publicly traded REITs, but the reality is they're not publicly traded, so you don't actually see the volatility in the price, even though it may very well be there. So really consider, what are the risks in the investments that you're considering, and do you need to take on those investment risks to accomplish your goals? what will the potential return really be for that? What's the actual range of outcomes that you can expect? And what difference would that make in your life if you actually saw those returns? Would it make the difference between retirement or not retirement, between being financially independent or not being financially independent? And on the flip side, what will the risk do to your life? Think about that worst case scenario in that range of outcomes. What impact will that investment going to zero have on your financial life? And is that worth it? Do you need to take on that risk? Is it meaningful for you? And should you? Really, I guess just thinking about when you think about these alternative investments, what is the purpose for it? Really, what goal, what cause is it fulfilling? Is it just fulfilling an itch that you feel like you want to invest in something more exotic because you feel like you should, or you hear your peers doing it? Is it going to perform a meaningful impact on your finances? Just what is the goal? What is the aim for it? And then lastly, also think about these trade-offs when you've won the game. Keep this in mind that there may potentially come a point in your life later in your career where you have won the game. You've built up enough wealth. You are financially secure, financially independent. And when you've built up enough wealth to where you don't need to take on additional investment risk, then you have to think carefully about whether you should, whether you need to. I've seen both sides. I've seen where people need to take on additional risk in order to make their goals feasible, hold more stock investments than they may have wanted otherwise in order to make it work. But there's also a point where I've seen where it really doesn't matter which direction you go. You can own more stocks. You can be much more conservative with your investing, and it really doesn't impact your financial independence either way. Hopefully, we're all able to get to that point. But you're able to live financially independently, and your mix of investments really doesn't materially impact that one way or another. So you have to think about whether do you really want to take on that additional risk? Do you want to add that additional anxiety, that additional worry when you really don't need to? And what would that do to that financial independence if sort of that worst case drawdown happened? Or that worst case scenario if it's like an individual investment or something like that. So think carefully about if you do get to that point when you've won the game, it's okay to just realize and recognize that you've won the game. You may not necessarily need to take on that additional risk. And that answer is different for everybody. Even considering things like estate planning. Like I've seen situations where we've helped the clients realize that they're financially independent enough to where they're really stewarding this wealth for their next generation, for the heirs. Like they've got plenty relative to their lifestyle. They've got plenty. So we've even done things like opening legacy trust accounts where that legacy bucket is for the next generation. And that's invested much more aggressively than they would have for their own. And that's just a way that they've been able to handle those trade-offs by segmenting it off for the future heirs. So there's a lot to think about there, and every family is different, but just keep that in mind as well. So as a summary, let's think about all the things we've talked about. You should plan to increase the amount of stocks and real estate in your investments if you have a higher ability or a capacity to take on risks. So you have a longer time horizon, you have higher job stability, or you have a higher confidence in your ability to get another job. Of course, you want to make sure you're building up enough liquidity, cash in your life to prepare for that, to hedge against that. You have a higher risk tolerance for the ups and downs in the short term to get those longer term expected returns. If you have a higher need for returns to reach those financial goals, if you're retiring with high amounts of multiple income streams that are stable, like Social Security, pensions, relative to your spending needs, you have extra returns that will provide you a really high impact to your life. If that's what they'll do, maybe that's a reason to increase your amount of stocks relative to bonds. And if you have a lot of other options when things don't go as planned, if you have that optionality, those are all reasons that you may consider increasing or having a higher having a higher amount of stocks relative to bonds. And, typically speaking, early in your career, these boxes are checked, right? You're probably going to have a higher amount of stocks relative to bonds, even potentially 100% stocks relative to bonds. And when should you have a lower amount of stocks relative to bonds? Well, that's when the opposite are true, right? You look through all these different factors, and if you see the opposite is true, then that might be a reason to go the other direction. When should you change the allocation, right? Because you might decide on it at one point in your career, at one point in your life. So when should you change it? When should you adjust it one way or another? The one reason that you should not make this adjustment is because of market events. So at stock declines, for example, in bear markets, that is definitely absolutely a time where you don't want to make that decision of making these changes. That's potentially the worst time. You want to make these changes instead based on changes in your life. So for example, getting a new job at a higher pay may be a reason. Getting into business or practice ownership is definitely a reason to reevaluate it. One example of this that I've seen is that a business owner may feel like they need to tap into their investment accounts in the near future in order to help cover their lifestyle expenses while they're building up their business. I've definitely seen that. I've even experienced that myself as I've cold started my practice. So you're not only seeing a loss of jobs of income stability, but you're seeing an increased need in liquidity. So that might actually be a reason, because your time horizon shorter potentially. That might be a reason to actually have less stocks in the mix of investments and more bonds or something more stable in order to prepare for that, right? So that's the reason you would do that. If there's a big career change, you might want to evaluate that. If you're approaching retirement or the time in your life where you're going to start to withdraw or need the funds, that's definitely a time where you want to just reevaluate that, or reevaluate the amount of bonds or cash you have available. As you get towards retirement, there's a really sensitive time where right as you start to withdraw those funds, what you really don't want to have happen is for a big decline in your investments right as you're starting to withdraw from them. We call that a sequence of return risks. So we don't know the order of returns, but what we want to sort of prepare or hedge against is that bad returns come right when you start needing to withdraw. Or another thing, if you have college costs that are starting to come up, and you've been saving all these years in a 529, that might be a reason to reevaluate it as you're getting closer to needing to spend the dollars. At funds added to your life, so if you are selling a practice, you have a huge amount of liquidity now, that might be a reason to reevaluate it. If you're receiving an inheritance, that would be a reason to evaluate it. Or any major changes in all of the different factors we talked about above. So life changes, not market events, are where you want to make decisions, reevaluate this. Reevaluate it every few years too. Just have a schedule of looking at it, acknowledging it. I look at this probably once every 4 years, roughly, just as a conversation. Not that we're really going to change anything, but with clients, just as a conversation to reevaluate it, making sure we're accounting for any life changes that come up. And these are decisions you want to make when things are okay, and you're making it without an emotional attachment or an emotional response, right? You want to try to make it when you're in a sound mind, things are relatively stable, it's not a huge decline. That's usually where you're not going to make your best decisions. So keep that in mind. Hopefully this was helpful as you think about how you should be investing your dollars. I mean, these are conversations I've had a lot of, and I've been a part of directly with my own clients in helping them to figure out what is the right mix to be in at the initial start of the relationship. I have a whole, hour-long conversation about this decision. To me, it's that important to start with education and to help clients come to their own decision in terms of what the right mix is for them. And then I've had conversations and have been a part of conversations with clients in evaluating changes. And I've been a part of those conversations where things are not as fun and clients want to make a panic decision or sell out at the bottom or have to be talked into staying where they're at and staying invested. And I've been a part of those conversations, and they're not fun. It's human nature to be anxious and scared when things are not as exciting, when you see your wealth fluctuating so much. But trying to make these decisions ahead of time as best as you can with the factors we talked about, and then reevaluating them over time based on changes in your life, I think that will get you on the right course. If you have any questions about anything we talked about today, please let me know. Reach out by email, Evon, EVON, at optometrywealth.com. You can check out all of the resources and links we mentioned today in the show notes, which you can find by scrolling down in whatever app you're in, or check out the show notes at the Education Hub on my website, www.optometrywealth.com. And while you're there, check out all the other articles, blog posts, episodes that we did in the Education Hub at my website. And while you're there, you can also feel free to schedule an introductory call. You can talk about whatever's on your mind financially, and we can talk about how we serve optometrists all over the country, navigate decisions like this, and so much more. And if you're not ready to chat, for my optometry listeners, I'm offering a free financial health assessment. All that means is you go to the link I've put in the show notes, download the app that I use with clients, take a few minutes to enter in your own financial information, and I will send over a short video talking about your scores, what they mean, and maybe even some next action step. So hopefully you've enjoyed the podcast. Hopefully we'll catch you on the next episode. I'm going to continue this investment theme for a little while, and hopefully we'll catch you then. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.